Hello, viewers. Welcome to the weekly roundup of news and events in the world of economics and finance. If you are new to this channel, kindly hit the subscribe and notification button to stay abreast of our posts each week. Let's get started.
The United States and Canada have plunged into a full-scale trade war after last-minute negotiations in Washington completely collapsed. The Trump administration immediately enforced a massive 50% tariff on roughly $20 billion worth of Canadian goods, striking everything from dairy and industrial machinery to hockey equipment. While U.S. Trade Representative Jamieson Greer blamed Canada for 11th-hour walkbacks, Canadian Prime Minister Mark Carney fiercely rejected the claim, accusing the U.S. of threatening their economic sovereignty. In response, Ottawa has suspended all trade talks and announced dollar-for-dollar retaliatory tariffs on American steel, appliances, and agriculture starting September 8th, leaving the future of the USMCA in serious jeopardy. The U.S. national debt has officially breached the historic $40 trillion milestone, fueled partly by $100 billion in sudden tariff refunds mandated by the Supreme Court. This staggering cash drain triggered panic in the bond market, sending the 30-year Treasury yield soaring to its highest level since 2007 as investors dumped government debt. To aggressively fight this sell-off and restore liquidity, Treasury Secretary Scott Bessent stepped in with an emergency intervention, announcing that the Treasury will at least double its long-term bond buybacks from $2 billion to $4 billion per operation starting September 9th. While Bessent downplayed the volatility and insisted the U.S. can grow its way out of the burden, Wall Street remains highly skeptical, with analysts warning that the era of cheap borrowing is officially over. Turning to the energy sector, average U.S. retail diesel prices have surged past $5.45 a gallon, marking the highest mid-August level in a decade. The spike is being driven by a brutal double whammy of geopolitical supply disruptions. The ongoing war with Iran has left the vital Strait of Hormuz largely closed to shipping traffic, while relentless Ukrainian drone strikes have severely crippled Russian refining infrastructure. Compounding the crisis, U.S. distillate inventories have plunged 13% below their 5-year average, just as the energy-intensive fall harvest season kicks into high gear. This tight supply bottleneck sent the U.S. diesel crack spread, a core metric of refining profitability, rocketing to an all-time high of $102,020 per barrel, sparking deep fears among analysts that these soaring transportation costs will inevitably trigger a new wave of broader consumer inflation. Over in Asia, data revealed that Japan's economy expanded at a disappointing annualized rate of 1.1% for the April to June quarter, significantly missing the 2.0% growth Wall Street economists had expected. While strong global demand for hybrid vehicles and artificial intelligence chips buoyed net exports, the broader recovery is losing steam as private consumption flattened and corporate business investment shrank by 1.2% due to persistent inflationary pressures. Resource-poor Japan is also bearing the brunt of the escalating conflict in Iran, which has driven oil import costs higher and forced the government to draw down national oil reserves. Despite 3 straight quarters of positive GDP growth, this deceleration leaves the Bank of Japan facing a delicate balancing act as it weighs further interest rate hikes amid sputtering domestic demand. Closer to home, data from Statistics Canada showed that Canada's annual inflation rate accelerated to 3.0% for the month, reversing the previous slowdown and hitting the absolute ceiling of the Bank of Canada's 1% to 3% control range. This hotter-than-expected print was heavily driven by a massive 25.7% year-over-year surge in gasoline prices, which re-accelerated as renewed United States-Iran hostilities choked off critical shipping routes. While core metrics like CPI trim and CPI median held steady near the 2% target, and shelter inflation actually cooled down to 1.3%, surging travel tour costs and persistent 3.1% grocery prices kept pressure high. This sudden energy-driven rebound forced money markets to immediately price out near-term rate cuts, meaning the Bank of Canada is now locked into a prolonged policy hold as it braces for the incoming inflationary shockwaves of the new U.S. tariff war. Shifting to Europe, global investors are turning aggressively bearish on French government bonds as a major political showdown looms over the country's upcoming 2027 budget, ahead of next April's presidential election. Data compiled by Bloomberg shows that short positions on 10-year French OAT contracts have surged to their highest level since June, driving the 10-year French yield above 4.10%, its highest level since 2008. Markets are severely punishing Paris for its deteriorating fundamentals, including a staggering public debt load nearing 118% of GDP and a fiscal deficit expected to blow past targets to 5.2%. With the benchmark French-German yield spread spiking past a critical 83 basis points, analysts warn that a deeply fractured, gridlocked parliament faces an uphill battle to implement necessary spending cuts, leaving France highly vulnerable to a major sovereign debt reckoning. Looking at Europe's largest powerhouse, official provisional data reveals that Germany's gross domestic product expanded by 0.2% in the second quarter. While this marks a modest deceleration from the upwardly revised 0.4% growth seen in Q1, it actually beat conservative Wall Street expectations of a 0.1% increase. This third consecutive quarter of expansion, pushing annual GDP growth up to 0.9%, was primarily rescued by strengthening export volumes. However, internal fundamentals remain deeply fragile, as household consumer spending stayed completely subdued, and capital investments dropped under the weight of a 2.8% inflation spike triggered by the wider Middle East conflict. Compounding these concerns, the German Bundesbank issued a stark warning that dangerously low water levels on the Rhine River are already disrupting domestic shipping lines, threatening to shave up to 0.2% off economic output and potentially drag Germany right back into stagnation for the third quarter. China's economic engine is flashing red with across-the-board weakness. Retail sales growth collapsed to a disappointing 2.7%, significantly missing Wall Street expectations as deeply cautious consumers choked back spending amid a worsening property crisis. Manufacturing offered no rescue either, with industrial production slowing sharply to 5.1% and fixed asset investment hitting its weakest pace of the year at 3.6%. The internal data looks even bleaker, as the urban youth unemployment rate surged back up to 17.1% and new home prices suffered their steepest month-over-month drop in 9 years. This comprehensive macroeconomic deceleration has left the broader market highly skeptical of Beijing's ability to hit its 5.0% annual growth target without launching a massive direct consumer stimulus package. Still in China, Shanghai has introduced a new round of housing purchase support measures, expanding the scope of use and frequency of Housing Provident Fund withdrawals, and lowering the minimum down payment ratio for purchasing a second home outside the outer ring road from 20% to 15%. We close with a major geopolitical escalation, as the United States is set to announce a sweeping plan next Monday to completely isolate Iran and its economic partners. This aggressive diplomatic maneuver takes direct aim at China, which remains the primary buyer of Iranian crude oil, importing hundreds of thousands of barrels a day through a network of independent teapot refineries. By threatening harsh secondary sanctions on any nation or institution doing business with Tehran, Washington is drawing a strict line in the sand that analysts warn will trigger renewed turbulence and deep economic friction in the U.S.-China relationship. As Beijing relies heavily on Iranian energy to fuel its industrial base, this incoming policy hammer threatens to completely derail fragile trade détentes and inject a volatile new wave of geopolitical risk into global commodity markets. That's all we have for this week. Thanks for watching, and remember to like, share, and subscribe to this channel. See you next week.